Are you ready to dive into the world of day trading? In this video, we go over everything you need to know to start a successful trading career. So, what is trading? In a nutshell, it's buying and selling assets in the financial markets with the goal of making a profit. Think of it like a giant flea market, but instead of used furniture and vintage clothes, we're talking stocks, bonds, currencies, and commodities, the building blocks of the global economy. Now, trading is the lifeblood of the financial world. It's what keeps the markets moving, it's what creates liquidity, and it's what allows investors like you and me to participate in the growth of companies and economies worldwide. Every time you buy shares of Apple because you think the iPhone 15 is going to be a game changer, you're engaging in trading. Every time you sell your Tesla stock because you're worried about Elon Musk's latest tweet, that's trading too. It's a dynamic, fast-paced world, and trust me, it's a heck of a lot more exciting than watching paint dry. But here's the thing. Trading is not just about buying low and selling high. It's about understanding the forces that drive market movements. It's about managing risk, and it's about developing a disciplined approach to navigate the ups and downs of the market. Think of it like surfing. You need to know how to read the waves, balance yourself on the board, and ride the momentum to succeed. And just like surfing, trading takes practice, patience, and a little bit of guts. But the rewards, my friends, can be absolutely incredible. We're talking financial freedom, the ability to control your own destiny, and the chance to build a brighter future for yourself and your loved ones. So if you're ready to embark on this exciting journey, stick with me because I'm about to break down everything you need to know to get started. All right, let's talk about the different playing fields where this trading game goes down, the markets. First up, we've got the stock market, the granddaddy of them all. This is where publicly traded companies like Apple, Amazon, and Tesla issue shares of their business, and you can buy a piece of the action. Then there's the bond market, a bit more laid back than the stock market, but still a major player. Here, governments and corporations issue bonds to raise capital, and investors like you can lend them money by buying these bonds in exchange for interest payments. Think of it like giving your friend a loan, but instead of your friend, it's a giant corporation or the US government, and trust me, they're usually good for it. Next, we've got the foreign exchange market, also known as forex. This is where currencies are traded against each other, and it's a 24/7 global party, folks. With trillions of dollars changing hands every single day, forex is the wild west of trading, full of opportunities and risks. And let's not forget about the commodities market, where raw materials like oil, gold, and coffee are bought and sold. This market is all about supply and demand, and if you can predict the next commodity boom, you're in for a wild ride. Each of these markets has its own quirks, its own language, and its own set of opportunities. But don't worry, we'll dive deeper into each of them later in this series. For now, just remember that the key to success in any market is understanding how it works, what drives its movements, and what strategies are most effective. It's like choosing the right tool for the job. You wouldn't use a hammer to tighten a screw, would you? So, take the time to learn about the different markets, find the one that resonates with you, and become an expert in that domain. Now, before we go any further, let's make sure we're all speaking the same language. Trading has its own lingo, and it's like learning a new language, but don't worry, I'm here to be your translator. First up, we've got stocks, also known as shares or equities. These represent ownership in a company. When you buy a stock, you're essentially buying a tiny piece of that company. Then there's bonds. These are like IOUs issued by governments or companies. When you buy a bond, you're lending money to the issuer in exchange for interest payments. Commodities are raw materials like oil, gold, and wheat. These are the building blocks of the global economy, and their prices fluctuate based on supply and demand. Currencies, as the name suggests, are the different forms of money used around the world, like the US dollar, the euro, and the Japanese yen. Bull market is a term you'll hear a lot in the trading world. It refers to a market that's on the rise, where prices are generally increasing. Bear market, on the other hand, is the opposite. It's a market that's in decline, where prices are generally decreasing. Volatility is a fancy word for how much the price of an asset fluctuates. High volatility means big price swings, while low volatility means smaller price swings. Liquidity refers to how easily you can buy or sell an asset. A highly liquid asset can be bought or sold quickly and easily, while an illiquid asset is harder to trade. Risk management is the process of identifying and mitigating potential losses in your trades. It's all about protecting your hard-earned money. These are just a few of the basic terms you'll encounter in the trading world. Don't worry if it seems overwhelming at first. Like anything else, it takes time and practice to master the lingo. But trust me, once you get a handle on the basics, you'll be well on your way to navigating the markets with confidence. So keep practicing, keep learning, and remember, I'm always here to help you along the way. All right, now that we've got the basics down, let's talk about the best brokers for day trading. These are the software programs that connect you to the markets and allow you to execute trades. Think of them like your cockpit, your command center, your portal to the exciting world of buying and selling assets. Now, there are a ton of trading platforms out there, each with its own strengths and weaknesses. But don't worry, I'm here to break down 3 of the most popular and powerful options: Interactive Brokers, E-Trade, and TradeZero. Interactive Brokers is known for its low trading costs and advanced trading tools, making it a favorite among professional traders. However, its complex interface can be overwhelming for beginners. E-Trade offers a user-friendly platform with a wide range of educational resources, making it ideal for both beginners and experienced traders. On the downside, its fees can be higher compared to other platforms. TradeZero is gaining popularity for its commission-free trading and fast execution speeds, making it a great choice for day traders. However, it lacks some of the advanced features found in other platforms. The best platform for you will depend on your individual needs and trading style. Do your research, try out different platforms, and see which one feels most comfortable and intuitive for you. Remember, the right trading platform can make all the difference in your trading success. Now, let's talk about fundamental analysis, the art of evaluating a company's financial health. Think of it like checking under the hood of a car before you buy it. You want to make sure the engine is in good shape, the transmission is smooth, and the brakes are working properly. Fundamental analysis is all about looking beyond the stock price and digging into the nitty-gritty of a company's financial statements. We're talking about analyzing their revenue, earnings, debt, cash flow, and all those other juicy financial metrics. The goal is to determine the intrinsic value of a company, or what it's actually worth based on its financial performance. Now, there are a ton of different metrics and ratios you can use in fundamental analysis. But don't worry, I'm here to break down some of the most important ones. First up, we've got the price-to-earnings ratio, or PE ratio for short. This ratio compares a company's stock price to its earnings per share, giving you an idea of how much investors are willing to pay for each dollar of earnings. Then there's the debt-to-equity ratio, which measures a company's financial leverage. This ratio tells you how much debt a company is using to finance its assets relative to its equity. We've also got the return on equity, or ROE, which measures a company's profitability. This ratio tells you how efficiently a company is using its equity to generate profits. And let's not forget about the current ratio, which measures a company's short-term liquidity. This ratio tells you how easily a company can cover its short-term liabilities with its current assets. These are just a few of the key metrics you can use in fundamental analysis. Remember, the goal is to get a comprehensive understanding of a company's financial health and determine whether its stock is overvalued, undervalued, or fairly valued. It takes time, practice, and a keen eye for detail. But trust me, the insights you gain from fundamental analysis are invaluable. All right, let's dive into the exciting world of technical analysis, the art of analyzing past market data to predict future price movements. Think of it like being a detective looking for clues and patterns in the charts to anticipate the market's next move. Technical analysts believe that history tends to repeat itself in the markets, and by studying historical price patterns, we can identify potential trading opportunities. Now, technical analysis relies heavily on charts, which are visual representations of price movements over time. These charts can show us trends, support and resistance levels, momentum indicators, and a whole lot more. One of the most basic concepts in technical analysis is support and resistance. Support is a price level, where a downtrend is likely to pause or reverse, while resistance is a price level, where an uptrend is likely to pause or reverse. Think of it like a floor and a ceiling for the price of an asset. Then we've got trend lines, which are lines drawn on a chart to connect a series of highs or lows, indicating the direction of the trend. Moving averages are another popular tool in technical analysis. These are calculated by averaging the closing prices of an asset over a specific period of time, helping to smooth out price fluctuations and identify the underlying trend. And let's not forget about oscillators, which are indicators that fluctuate between a set range, helping to identify overbought or oversold conditions in the market. Technical analysis is a vast and complex field, but don't let that intimidate you. The key is to start with the basics, learn the different tools and techniques, and practice, practice, practice. Remember, technical analysis is all about identifying patterns and probabilities, not guarantees. There's no crystal ball in trading, but by understanding technical analysis, you can gain a significant edge in the markets. We've covered a lot of ground today, from the basics of trading to the intricacies of fundamental and technical analysis. Remember, trading is a journey, not a destination. It takes time, effort, and a willingness to learn and adapt. The markets are constantly evolving, so stay curious, stay informed, and never stop learning. Take the first step. Open a demo account and start practicing what you've learned. The exciting world of trading awaits.